Welcome back. Now we'll look at where markets ended a very wild week on Wall Street. The major averages on Wednesday logging their worst day in more than 4 months after Federal Reserve Chairman Jay Powell signaled fewer rate cuts next year, and Congress struggled to fund the government. We also got the final read of third quarter GDP this week. It came in higher than expected at growth of 3.1%, and the Fed's preferred inflation rate came in slightly below expectations at 2.4%. But it is still above last month's 2.3% rate of inflation. Joining me now is Piper Sandler's chief investment strategist, Michael Kantrowitz. Michael, good to see you. Thank you so much for being here. Let me kick it off with your assessment of where the macro story is right now. How would you assess things?
Right now, the financial markets are extremely focused once again on inflation and the risk of higher interest rates. You know, we had a great year this year as we priced out we priced in the end of the tightening cycle and the beginning of an easing cycle. And perhaps the market went too far by September. And because the economy has stayed okay, we've seen rates back up, interest rate cut expectations being pared back. And with this past week's Fed meeting, it somewhat reset expectations with the reset of the Fed's own dot plot and inflation expectations. So the markets have kind of pared back some of that enthusiasm through multiple compression as interest rates have backed up. So really, the data on inflation and employment are going to be the most important data for the equity market because they're the most important data for the bond market and the Fed.
So what do you want to do as an investor? I mean, look, we're still looking at very strong gains year to date, but December has been a rocky month. How do you want to allocate capital going into the new year?
We've been generally we've been on the side of being kind of overweight areas of the market that we deem as quality. So these are typically larger companies with healthier balance sheets, fatter profit margins, stronger free cash flow yield, and earnings momentum. You know, one of the areas of across the markets that have done really well this year on a relative and absolute basis or just in general, those stocks that have seen continued earnings, positive earnings revisions. And that's true in the U.S. versus the rest of the world. It's true in large caps versus small caps. And it's been a theme within sectors as well. So I think that'll continue to be really important next year. And our macro outlook is that the economy isn't going to radically change all that much. We're still going to we're still going to have an okay economy. There's certainly some tailwinds from the global easing cycle and lower commodity prices, but there's also some potential headwinds that can prevent a real strong reacceleration in the economy, like high interest rates that are affecting the housing market and the let's say the bottom part of the K-shaped economy we have today that are still struggling from high prices and high interest rates. So we do see some cyclical improvement in some data like manufacturing PMIs, but I think the upside is somewhat limited, but better nonetheless.
So do you want to stick to some of those high flyers, Michael? Because a lot of the risk on names have come off of their highs. Look at Bitcoin, look at big tech. Do you still like those names now, and would you put new money to work there?
Well, yeah, it's companies that will continue to see free cash flow and earnings momentum will, in our opinion, continue to outperform. So, you know, I don't want to narrow it all the way down to the Mag 7, but, you know, what you do want to avoid is stocks that have become expensive and are purely betting on interest rates going down. I think that's an area of the market, and that's kind of small caps in a way that, you know, certainly had a great move in earlier this fourth quarter when rates started coming down. But if rates stay sticky and inflation stays sticky, I do think those larger companies will continue to outperform because they have economies of scale and can continue to do well in this environment.
All right, we will leave it there. Michael, always a pleasure. Thanks so much.